You have a Fed that's guiding the market to cut, but this real question and what Powell was alluding to yesterday is they really don't know the level that they're going to cut rates to. A lot of questions around what that neutral rate is. It's a really abstract concept, but it's this idea that the Fed's hiked so much already, and we're really not seeing much of that cooling in economic activity. Seeing a lot of great progress on the inflation front, so that's what's going to drive the cuts. But really at the end of the day, this could be a very different cutting cycle than what we've seen in the past when the Fed is cutting to really ease conditions.
Well, given the Fed, I mean, there's a lot of cross currents out there. One of the big ones is the labor market. We're going to get jobless claims today, non-farm payrolls tomorrow.
Yeah.
How are you guys thinking about that?
So the labor market data is important, but really at the end of the day, when we're listening to the Fed, they know that the labor market data has been really strong. And so this question about when is it time for the Fed to cut really comes down to the inflation numbers. Recently, these inflation numbers have not been great for them. They're showing some signs of picking up, particularly in some of these cyclical components. So that really is what we think is going to weigh and move the needle more for the Fed than necessarily some of this labor market data.
Well, we started the year, the WIRP function on the Bloomberg terminal was suggesting maybe as many as 6 rate cuts. Now we're 3 or maybe even less than 3.
I'm not even watching it.
I know. It's kind of lost a lot of credibility with some people, the WIRP function. How many rate cuts are we going to see this year, do you think?
So House view of B of A's 75 basis points of cuts. So we see the Fed delivering that first 25 basis point cut in June. But here's the difficulty. If they're not able to go by June, you get some questions around how close they can really begin that cutting cycle around the election season. And then you've also got base effects coming from even just core PCE into the second half of the year.
Yeah, the lead guitar effects are as bad as well. Meghan, let me cut to the chase here, which is, I would say nobody has a clue where we're going other than in the fixed income space, as witnessed by the real yield, we see a buoyant economy.
Yes.
Give us a primer on what a 2% 10-year real yield signals.
2% 10-year real yield is a nice investment opportunity for a lot of different clients, especially when we're looking at how much the equity market has rallied already. If you're worried about, some of these downside states of the U.S. economy, this is why people want to be buying duration. They want to be buying U.S. rates. But the issue here, again, is that we're not seeing this very meaningful cool down in the U.S. economy. And so rates are priced accordingly. We're having a lot of inflows into fixed income. I mean, you just look at IG high yield spreads, a lot of demand there.
What inflows are you seeing at Bank of America?
I mean, what we're seeing is very strong inflows into fixed income funds across the board. And that's really helped support this tremendous amount of treasury supply that we see coming to the market, and also investment grade credit supply. There's been a lot of demand to chase these higher yields. The real question here is just how much are we actually going to be able to see yields fall if the U.S. economy is staying so resilient?
Meghan, here, I mean, I think one of the concerns for a lot of folks is people are saying this Fed is already behind the ball. Inflation is whipped. They should be cutting now. What do you say to those folks?
So the idea here is that a lot of the improvement that we've seen from the inflation backdrop so far has really been supply driven. It's been the story of the improvement in goods inflation, which was the easy part of the story. It was the part of the story that the Fed knew was going to be more transitory. The big question for the Fed and what we'll see in the upcoming data prints is whether or not we see more of this cooling in services. This is very important for inflation to come in sustainably where they want it to. So, certainly a lot of good progress has been made. The big question is the confidence and conviction around that staying where it is.
30 seconds. We're all watching Final Four with Meghan Swiber. And somebody asks you, are you worried about the ballooning interest expense of the United States of America? Are you?
So this is actually a very big part of certainly how we're thinking about deficits going forward. And this is really where higher for longer can become a big problem for the largest borrower in the world. If you're seeing rates settle above a 3-4% handle, that's above where we think the long run GDP growth is of the US economy and can contribute to a lot of these financing costs. So it's a concern, especially in an environment where the Fed's not going to be able to cut all that much.